The journey from having $0 in the bank to owning your first investment is less about being a math genius and more about building a series of simple mechanical habits. Most people stay stuck at zero because they think investing is a playground reserved for the wealthy, but the reality is that wealth is built through a roadmap of 5 specific stages. Stage 1 is the defense phase, where you focus on a starter emergency fund. You need to gather $1,000 as quickly as humanly possible. This isn't your long-term savings, it is your anti-disaster insurance. These $1,000 act as a psychological barrier that proves you can actually hold onto money. To get this first grand, you have to be aggressive. This is the phase where you sell the old gear in your garage or cut every unnecessary subscription for 30 days. You aren't looking for a sustainable lifestyle yet. You are looking for the spark to start the engine. Once that $1,000 buffer is in place, stage 2 is about killing wealth killers, which is high interest debt. If you have a credit card balance with a 20% interest rate, there is no investment in the world, not stocks, not real estate, that can consistently beat the 20% loss. Paying off that card is the equivalent of getting a guaranteed 20% return on your money, which is a better deal than even the world's greatest investors get. In this stage, you list your debts from smallest to largest and attack them with every extra dollar you have. As you clear these balances, you aren't just losing debt, you are buying back your monthly cash flow, which gives you the fuel you need for the next steps. Stage 3 is the fortress phase, where you turn that $1,000 starter fund into a full emergency fund that covers 3 to 6 months of your living expenses. This is the step most people try to skip because they are excited to buy stocks, but skipping this is a massive mistake. If you put all your money into the market and the economy hits a recession, the stock market will likely be down. At the same time, you might face a job loss. Without this cash cushion, you would be forced to sell your investments at a loss just to pay rent. A full emergency fund is a bravery money. It gives you the peace of mind to stay invested when the market gets volatile, ensuring that once you start investing, you never have to pull money out in a panic. Stage 4 is finally entering the arena by opening your first investment account. For most people, the best entry point is a Roth IRA or a 401k. If your employer offers a 401k match, that is a 100% return on your money before it even hits the market. If you don't have that, a Roth IRA is a fantastic tool because your money grows entirely tax-free. When you log into that account, don't get distracted by meme stocks or whatever is trending on social media. Instead, look for a low-cost S&P 500 index fund or ETF. This allows you to own a tiny piece of the 500 biggest companies in America all at once. It is instant diversification and it requires zero complicated research on your part. The final stage is the automation phase, where you move from someone who tried investing to someone who is an investor. This is where you set up a recurring transfer so that a set amount of money moves from your paycheck to your investments automatically every month. This removes your emotions from the equation entirely. You stop checking the news to see if it is a good day to buy, and you let the math of compound interest do the heavy lifting. You started at zero, built a shield of cash, killed your debt, and now you are watching your money make its own money. The only thing left to do is stay the course and let time turn your small contributions into a significant fortune.